welcome to another Southbank investment bulletin. So I thought I'd kick off with Brookfield Corp. Now I imagine that the vast majority of investors in the UK have probably never heard of Brookfield, but it is one of the most successful, probably the most successful private equity group that focuses on property. And they have done spectacularly well. And I think it's particularly relevant just to highlight that it used to trade back in 97 at about $1.50 and it got up to $50. But there have been multiple occasions when it's been split up and in the fashion of private equity groups. So, for example, there is a Brookfield Renewables partnership, and that has a significant weighting in solar, or perhaps it might be more accurate to say utility scale solar installations. It did enormously well in 2019 and 20, and then it has come down heavily over the last 2 years and pulling back from the region of both the 200-day and 1,000-day moving averages today. And I think it's also relevant that the 200-day is falling through the 1,000-day, which is pretty much and obviously it's not a big move yet, but it's an indication of a bear market. Now, when we think then about more recent history, I think it's very relevant to highlight that Brookfield Asset Management was moved out of Brookfield Corp in December of last year. Now, why on earth would a big private equity firm that has been enormously successful decide that they're going to separate their decision-making body from their assets? Well, one reason for that might potentially be that they don't believe the value of those assets are going to hold up. So the asset manager, which basically is the decision-making arm of Brookfield, is worth about 13 trillion and billion. But then that's a significant proportion of what the value of the total company was before the demerger. And I think this is especially relevant because interest rates are starting to come back down. The 10-year yield has contracted through the 3.5% level. Now, we've had just this week two different important people speaking. And I'm not including Andrew Bailey and the Bank of England's interest rate hike in that number. But you had Jay Powell basically saying yesterday they're going to continue raising rates until they can get inflation back down to 2%. Now, the market does not believe that. In fact, the bond market is pricing in right now that they're going to be cutting rates by the end of this year, and they might be cutting as many as 3 times by the end of this year, even if they're going to raise rates again at the next meeting. Well, that's basically pricing in the potential that we're going to have a sharp economic contraction at some point in the next 3 or 4 months that's going to necessitate a big move by the Federal Reserve. But then you had Janet Yellen speaking in front of Congress yesterday. And what she basically said was that she's not all that keen on a blanket guarantee for depositors. So the regional banks index has now broken down to a new closing low. And this is an extension of what has been a really profound breakdown over the last 3 weeks. So there is obviously more room on the downside for these regional banks. And it got me in mind of what I refer to as regulatory arbitrage. And what we have here is private equity firms that are under pressure because the value of the assets they hold is declining because interest rates have gone up and the economy is slowing down. And then particularly for Brookfield, they have commercial properties. And with so many people still working from home, then a lot of those commercial properties are empty. And that basically is making it very hard to justify the exorbitant rents that were being charged on those commercial properties. So there are a number of factors that are now weighted against these private equity investors, but they benefited from regulatory arbitrage over the course of the last 40 years. For one thing, they have the carried interest exemption. So they get to write off any investments that they've put into businesses, and they get to sharply minimize their tax burden because of that. So they're avoiding some of the regulation that other companies have to deal with. Then they benefited enormously from the low interest rate environment and the fact that asset prices were rallying for a long time. So then the expected returns from the investments they've been making have been going down because the price has been rising. But I also think then regulatory arbitrage is an important way to think about what's happening to regional banks in the USA. Because what it basically means is that they didn't have to hold the same amount of capital as larger banks, and that allowed them to have greater leverage. And now that that business model is being threatened, well, then they're coming down heavily. And with Janet Yellen not all that keen on blanket guarantees for depositors, well, then that suggests that there's a clear incentive for anyone who has any money to take it out of these banks. And that's really not good news. Now, when we think about what's going on in the UK, well, inflationary pressures are still too high. And they're being driven higher by imported food costs and clothing costs and services costs. And nonetheless, the 10-year yield has started to come back down. So even though the UK has avoided a recession so far, the bond market is beginning to price in the potential that that is not going to remain the case. So we've had the acceleration higher in yields in the middle of last year. Then we've had a sharp drawdown and a period now of ranging over the last few months. This is not a bullish pattern, and it suggests that if we see yields coming below 3%, they could be at 2% in a really quite short period of time. What I think is quite likely is that we are in store for a deflationary shock, which would follow smartly on the heels of the inflationary shock that we've had over the last couple of years. Then, because interest rates are starting to come down, or I guess because bond yields are starting to come down, interest rates have not yet moved. Gold prices are starting to appreciate. So we had the big pop on the upside last week, a little bit of pause in the early part of this week, and now it is right back in the region of the psychological $2,000 level. But gold has already broken higher in several other major currencies. So against the pound, it popped up through £1,600 and paused, but then improved in here today. It's also broken higher against currencies like the euro and then also the yen. Now, I think there's a reasonable understanding right now that the UK has large numbers of mortgages that are on floating rates, or they're on fixes that are going to have to be rolled over this year. But what we also have is Japan, and there are 70% of all Japanese mortgages have a floating rate. Now, this is really quite important because the Japanese government bond yield has been hovering here and with good reason, because the central bank is curtailing the ability of the yield to rally. Now, the yield right now is at 32 basis points, and you can see that it got up to about 50, and that is the cap. They're not going to allow it to go higher than that. but yields are starting to come back down. So even in Japan, where they are trying their best to actually create inflation, bond yields have contracted. And that is beginning to suggest that there's potential here that what we should be more worried about is deflation than inflation. But what it also is suggesting is that at some stage, investors are, and particularly Japanese investors, are going to look at the low yields that are available domestically, and they're going to want to put their money aside and move it overseas. Now, Japanese cash deposits are absolutely enormous. So if the yen starts to depreciate again, which would mean that this chart versus the dollar starts going up, then that would represent a clear movement of fresh cash out into the global economy. And we do have to monitor these things because capital is mobile and global. So when it starts to move again, we're going to have a big bull market, and valuations are going to be significantly depressed. And that is the best entry point for a new bull market. And when we then think about the fact that we're seeing the FTSE 100 exhibit quite a lot of relative strength, and it has bounced fairly impressively this week. Now, I don't anticipate it marching straight back up to 8,000. I anticipate that there will be a fair amount of ranging, but this is significant relative strength compared to that weakness we're seeing in the US banking sector. And when liquidity conditions do improve, when we do see interest rate cuts, and more likely than not, that central bank balance sheets are going to start increasing once more. And we already have a weakening dollar. So that's supporting gold. It will also support non-US assets. So the recipe is certainly clear for a new bull market. It's just that we don't yet have all of the ingredients. But that shopping list is going to get shorter the further we go on in the year, because that's basically what the bond market is telling us. And I think with that, I will leave you for today, and I'll wish all the best to all of you.